Welcome to Intelligent Investor Insights with Joshua and Robert Barone. They're your co-hosts and guides through the noise of today's markets. Here we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
This is Bob Barone, and I'm here with my son and co-host Joshua, the only person I know who can make the Fed's dot plot sound like a cliffhanger from a Netflix series. Last week, he tried to convince me that revisions to GDP should qualify as an Olympic event. Strong fundamentals, compulsory routines, and judges who change the score 3 months later. If they ever roll it out, Josh is already lobbying to coach the U.S. team. Today, though, we're turning our attention to what used to be the North Star of global markets, the U.S. Treasury yield curve. And Josh, let's be honest, calling it a compass these days is optimistic. This thing is spinning so wildly that if it were mounted on a ship, the captain would have thrown it overboard by now.
Yeah, and I gotta admit, Dad, I remember when you checked the shape of the yield curve before you even touched your coffee. Back in the 80s, traders treated every wiggle like a revelation. Now, you look at the curve and it tells you less about where the economy's going and more about the headaches coming out of Washington's funding department. It's being pulled out of shape by massive deficit spending and the Treasury's obsession with short-term debt. You can't trust it the way you could in, say, 1989.
Exactly. The slope used to capture growth and inflation expectations. Steep meant the economy had momentum, and an inverted slope usually signaled trouble ahead. But now you look at why it's inverted or flat, and it's not market fear, it's supply. Treasury's financing decisions dictate the shape, not some market-based price discovery. That's not a compass, Josh. That's a weather vane catching gusts from every new auction.
And the problem is, policymakers are still treating these signals as gospel, which leads to, well, we'll get to the misguided policy part in a bit. For investors, though, pretend that the yield curve is telling you where the economy's headed and you're flying blind. Let's zoom in on what's really going on. Implicit yield curve control, or YCC. Japan does it with the central bank. Explicit, waving a flag, we'll cap that yield at 0. Here in the States, it's stealth. Treasury auctions, not the Fed, keep yields pinned just by the way debt gets issued. It looks technical, but the outcome's the same. Markets aren't setting rates. Policy choices are.
Right, Japan makes no bones about it. They'll buy every 10-year JGB in sight to cap yields. Here we call it debt management, as if that makes it less distorting. The deluge of short-term issuance, especially the 2-year note, crowds the front end, while longer-term auctions and buybacks are carefully managed to keep the long end from getting out of line. But the real effect? The yield curve's just an artifact of how the Treasury slices up its funding needs each month, not a forecast of anything.
So all the models that depend on the forward or the curve shape, they're getting signals that aren't grounded in market risk anymore. Dad, if you're building an allocation model on that stuff, I'd start looking for a new blueprint.
Honestly, if you're trusting those curve-based signals without understanding what's propping them up, you're driving at night with the cruise control set and the headlights off. The reality is asset allocation models need to adapt fast because the rules have changed, even if the policy folks in DC haven't gotten the memo yet. And it's not just the yield curve. A lot of what's driving policy these days is built on sand. Think about labor market data, the BLS payrolls, the shelter component in CPI. Flawed measurement after flawed measurement inflates the case for tight policy. You dig into the establishment survey versus the household survey, for example, they aren't even close.
No kidding. I still remember that time you redlined my GDP summary, drove home just how bad trusting the headline can get you burned. The first time I quoted the BLS number without checking the household survey, you took a ruler to my analysis. Fast forward to now, and you're seeing stuff like establishment payrolls claiming 151,000 jobs added, while the household survey loses 500,000 in the same month. Or the shelter CPI. A good chunk of inflation is driven by a laggy survey that's detached from what renters are actually paying right now.
Shelter is running about 3.6% year over year, according to the BLS. But private sector rent data, that's already negative. It's like steering the car by looking in the rearview mirror. You build policy off flawed or stale data, you end up tightening into weakness or missing the turn entirely.
So the Fed keeps rates pinned high because inflation is sticky. But if you had real-time rent data and honest labor numbers, I'm pretty sure policy would look a whole lot different.
The real problem is that those policy mistakes get amplified by all the curve distortions we're talking about. Insufficient data and manipulated signals make for a dangerous feedback loop.
All right, let's dig into what's become the Achilles heel of the whole system, the 2-year Treasury note. Janet Yellen turned it into her favorite funding tool for those trillion-dollar deficits. Auction sizes hit $70 billion a month by mid-2025. Now, nearly $5 trillion is maturing in 2 years or less, which means every couple of years, the Treasury's got to roll over all that debt at whatever rate the market's demanding.
It's musical chairs with a shrinking circle. Yellen's obsession with the front end shifted risk to these rollover windows. Scott Bessent, her successor, now has to deal with rolling all this paper at much higher rates. Gone are the days of refinancing at ultra-low rates. The upshot is a substantial structural fragility. If just one 2-year auction wobbles, the ripple effect will hit repo, then extend right across to equities and corporate credit. The 2-year period is now a single point of failure.
If you're a risk manager, you have to ask, what happens when the rollover burden bites just as rates spike? All those models that assume steady demand at every auction could get blindsided. The short-term thinking built into funding decisions is coming due fast, and the handoff from Yellen to Bessent, it wasn't exactly a smooth baton pass.
And the paradox is the longer end of the curve is being massaged by steady coupon supply and buybacks, so investors don't see the actual fiscal risk there. All the pressure's up front. That isn't a signal, Josh, it's a warning siren. Let's talk about the knock-on effects. Curve distortions don't stop with treasuries. They bleed into everything with a price tag strapped to the curve. Corporate bond pricing, mortgage rates, equity valuations, they're all built on shaky foundations now. Risk premiums are artificially compressed, and spreads are the tightest they've been in over a decade.
Totally. Take forward rates. They're supposed to tell you what the Fed's likely to do, but lately they're just echoing Treasury supply, not any fundamental policy outlook. Corporate bond spreads? Triple Bs act like defaults are just off the table, and the underlying balance sheets don't justify that kind of optimism. It's all propped up by headline job numbers that'll probably get revised away. Equities too. Valuations look bulletproof, but the fundamentals under the surface just aren't there.
That's the mirage effect I keep warning about when official data exaggerates job strength. The stock and bond markets price in resilience that isn't real. So models based on this data, they're systematically off the mark. Fragility builds quietly until one shock forces everything to reprice at once.
Yeah, and if risk premia are this tight because of phony signals, all it's going to take is one bad auction or a sudden liquidity squall for the dam to burst. That's not just theory, that's how systemic risks creep up on you. Let's shift gears to liquidity. The Fed's overnight reverse repo facility, once the system's big shock absorber, is basically empty. At its peak in 2022, RRP soaked up $2.6 trillion in excess liquidity. Fast forward to August 2025, and it's down near zero. That means the system's lost its cushion.
With the Fed shrinking the balance sheet and the Treasury flooding the market with short-end paper, money funds have moved out of repo and into T-bills. So what used to be a safe parking spot for cash is gone. And now the system's running without training wheels. The knock-on? Dealers are maxed out by regulatory leverage ratios, making it hard to absorb all that incoming supply. Repo markets are already flashing volatility, especially around quarter ends, collateral shortages, balance sheet triage, and spikes in rates, all classic preconditions for a funding squeeze.
And you layer in drain liquidity, it's like driving with no spare tire. One bad settlement date and the wheels come off fast. I'm still seeing folks act like funding stress is some relic of the 2008 era. It's not. It's just hiding behind all this Treasury supply and regulatory inertia.
And the real question nobody's asking is, are institutions and investors prepared for these flash flare-ups? Or is everyone assuming the Fed will always catch them? Once the RRP buffer's gone, that bet gets a lot dicier. Now, if you want a preview of how market confidence unravels, look at foreign sponsorship. Japan's still the biggest holder, but selling surges every time they need to defend the yen. China trimmed its Treasury holdings to stabilize around $756 billion and pumped up gold reserves to over 2,299 tons. That's not diversification. It's a clear move away from dollar assets. The reasons? They're part yield competition, part dollar weaponization. Sanctions and reserve freezes after Ukraine sent a message. Treasuries now carry political risk too.
Back in the day, we talked about foreign treasury demand as basically inexhaustible. But now, every new auction feels heavier. Bid to cover ratios are dropping, auction tails are wider, and bid-ask spreads, usually razor thin, are getting chunky. I mean, when the FAR BNY is flagging trouble at 2-year auctions, you know the market's not chewing through supply like it used to.
Exactly. Price discovery gets stifled when auctions are constantly strained by too much supply and not enough natural buyers stepping up. Dealers can't absorb it, and that undermines the curve's reliability as a risk benchmark for the entire system. This isn't a healthy market digesting supply. It's policy dictating what yields should be, with mounting microstructure stress as a result.
And if foreign buyers keep backing away, the weight falls squarely on domestic investors and dealers already running lean. We're not immune, and it's a lot easier to break something than it is to fix it in real time.
There's no free lunch. When the U curve becomes a hall of mirrors, warped by supply, rolled over at punishing rates, foreign sponsorship drying up, mispricing isn't a bug, it's the baseline now.
That's going to wrap up today's episode. If you haven't already checked out our deep dive into Bitcoin's underlying infrastructure, what real decentralization actually protects you from, and what it absolutely doesn't, make sure to give that a listen. We'll be back soon digging into the next set of cracks forming beneath the surface of this economy. And trust me, there are plenty more to explore. Stay tuned.
All right, Josh, always a pleasure. Stay disciplined out there, everyone. If you're depending on the old signals, you might want to recalibrate before the next auction. Thanks for tuning in, and we'll see you next time.
Take care, Dad. See you soon. And thanks to everyone for listening. Goodbye for now.
Thanks for joining Robert and Joshua on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.